Hey YouTube, what's going on? Welcome back to Calvin Lim Investing. As usual, I'm your host Calvin, and today we're going to go through some of the options basics. We're going to look at a couple of key terms in options, what they do, and then also look at implied volatility. So before we get started, a couple of things to point out. I am not a financial expert or an advisor, so please contact an advisor if you do plan on investing, and make sure to always do your due diligence. Second of all, I am using Robinhood for this example and to be looking at tickers, but with all the stuff that's going on, there are definitely other brokerages to use, so please don't think I'm using Robinhood because I'm a huge supporter. I definitely think there are a bunch of other brokerages that are available to be used, but I'm currently using Robinhood only for this challenge account that I've been working on. So, last of all, before we get started, if you could just scroll down, subscribe, show a little love, I definitely appreciate it, and I do really enjoy making these videos. With that being said, let's get down to it. So the Greeks are sort of variables and factors to help you determine how an option is going to move, whether it's going to move how much it's going to move in a certain direction. There's delta, gamma, vega, and theta. But rather than knowing all of these, we're going to be strictly looking at delta and theta. So let's take a look at Facebook. It's trading around 267 at the moment, and let's take a look at Facebook options. So as you can see, I'm selecting a $265 call for next week. There's a delta of 0.62, which basically means for each dollar that Facebook increases, the value of the option should increase by 63 cents. So for example, Facebook opens up at 268. If all these other factors are constant, and Facebook, this $265 call should have gone up about 63 cents. The delta is pretty much the rate of change in the option relative to the change in a dollar of the underlying ticker. So if Facebook goes up by $5, delta is going to go up by 0.63 times 5, which is about $3 and a little bit of change. So delta really tells you how much you should expect an option to move when the stock moves. On the inverse, the delta for a far out of the money option could be a lot lower than something that's in the money. So if you look at it, this 265 is in the money. The delta is about 0.62. If you look at something that's like 255, the delta is almost 0.89. So as you go deeper in the money, there's less quote unquote time premium, and your option becomes more and more heavily on the delta side. And then if you go over something out of the money, as I said, you can see that delta is significantly lower. This $285 call, there's a delta of only 7 cents. So if Facebook jumps up $1, you should only see this option increase by 7 cents. Next of all, we're going to look at theta. So theta is also known as time decay. What happens is that if these factors, or if these other factors if delta, gamma, vega, and rho are constant and have no change, and that Facebook opens up Monday at 267, theoretically this call will decrease in value by about 23 to 24 cents. So theta is sort of the rate of time decay if your option remains stagnant or constant. If it is not moving up, if your ticker or your stock isn't moving up, theta is gonna whittle down the value of your option, and it's known as a premium killer. Theta is especially important in the last week before an option expires. It definitely really kicks in within 1 week to go and 2 weeks to go. So if you're looking to buy a call or a put for a given ticker, be sure to look at theta and delta, and also be careful about selecting something that's really close to expiration. There's a reason why these options are extremely cheaper than something maybe a month out, and that's because of theta decay. Now, next off, we're going to look at implied volatility. Implied volatility is the market's forecast of a likely movement in a security's price. Something with higher implied volatility means that there is a lot more expectations that the stock is going to move a certain way. You can see that Facebook has an implied volatility of 27.3%. Usually during a catalyst event week or earnings week, you'll see implied volatility jump, right? Because there's a larger expected move. Implied volatility doesn't say it's going to necessarily go up, but it's going to be sort of the priced in move via contracts. So if you look at something that's more volatile, you'll see a higher implied volatility. Let's take a look at maybe GameStop. So taking a look at GameStop options, it's trading around $66. So let's look at the $70, right? So you can see that the implied volatility is 453%. That means there's a quote unquote larger expected move for GameStop. You don't know which direction, right? And look at this delta, it's expected to move about 56 cents per dollar move in GameStop. The theta is negative 1.12. Theta is always going to be negative because it has an inverse relationship with time, right? As time, or has a not an inverse relationship, it has a strong relationship with time. As time goes on, theta starts to increase as well. So you can see that the three most important factors when trading options is delta, theta, and implied volatility. So be sure to check out another upcoming video that I have, which is going to talk about how you can take advantage of theta and implied volatility to generate constant gains and constant returns on a weekly basis. Thank you guys so much for tuning in.